All right, guys, welcome back to the channel. So today we had a request saying, I keep seeing videos on XLE. Can you make a video of that? So today we're going to make a video of XLE and we're going to compare it to the FENY ETF that I just created. So we're using the Fidelity website to look at the XLE, the Energy Select Spider SPDR fund, listed at $97.72. This is a sector that is focused solely on energy. So now let's just go over the quick overview. You can see we're at $97 to $98. The expense ratio and net expense ratio are 0.09, which is very competitive. Net assets are around 39 billion. Now I want to scroll down just so you guys can see, looking at the profile. You always want to check this out when you're looking at an ETF. So XLE's prospectus says that 95% of its total assets are comprised within the energy companies by the GICS. This includes the industries of oil, gas, consumable fuels, energy equipment, and services. It's not diversified. It's only in these select few. So doing a quick overview of XLE, we can see the top three holdings are XOM at 22%, Chevron at 17%, and COP at 8%, which we will compare to FENY. Later on, we go over the composition. Energy sector, 99% of this ETF, and invest mainly in large cap companies. As you can see, the 1 year it's up 17%, 3 years 29%, 5 years 13%, and the life is about 8.42%, which is doing very well. So on Fidelity, you can review the chart. As you can see here, we have the chart. It has gone all the way up in the last year from $80 all the way up to $97. Let's just go to max so you can see it opening up at $20. Now it's blasting all the way up to highs of 100. So we're definitely buying at the high if we think that this is going to be potential. But if you're going to do this, you have to dollar cost average in. It's too risky to be just putting all your money in at $97 when you've seen the past go down this much. Anyways, looking at the composition, this is what I wanted to show you. This is what's more important if you're looking at this company, or ETF, I should say, long term. So it's a passively managed equity energy. And when we look at the ETF holdings, it's only 26 companies. So that's, for me, that's a lot of concentration risk. And it's almost as if you should just buy the top 3 energy guys and just hold them instead. The reason I'm saying this is because if you look at the top 26, the top 10 companies are 75.63%, whereas the other, so that means 16 companies make up 24%. So ExxonMobil's the big dog at 22%, Chevron at 17%, ConocoPhillips at 8%, and then the list kind of goes on. Take a snapshot if you need to, but just look at that concentration risk. If ExxonMobil goes down, or Chevron or ConocoPhillips, you're taking a huge hit. So equity, it's all in North America. It's all in giant and large cap companies and medium, as you can see here, making up most of it. It's more of a value play. Value and large cap companies. They have over 100 billion in assets, and oil, gas, consumable fuels, energy, equipment, and services. Now, what I want to show you though is look at the composition and focus on ExxonMobil being 22%, Chevron 17%, and ConocoPhillips 8%. Look at FENY. This is FENY's ETF, very close. Top 10 instead of 75% makes up 65%, and Chevron makes up 14% compared to the 17%. So you're giving up 1 or 2% for ExxonMobil for XLE compared to FENY. As you can see here, 21.96 versus 22.88. Chevron XLE is 17.43 versus FENY, which is 14.53. So to me, it's not that much of a difference. The only difference is that FENY has a little bit more less concentration risk at the 121 companies, and that's why I recommended it, because you're not just buying 26 companies in XLE, where these top 10 make up almost 76% of the ETF. To me, that's a lot of concentration risk, and it's too much for me to kind of stomach. But everybody has their own investment goals, and I just wanted you to at least see that and be aware of the differences right there. Now let's look at the distribution expenses. I love the distribution yield of 3.09%. I think that is an excellent return. You're going to get 3% over time, and you're paying a small fee of 0.09% for XLE. So, and you get paid quarterly dividends, and Fidelity just shows you how each quarter you're getting paid. So you could see in, Q2, let's go to Q1 of 2024. It's more relevant. Ex-dividend date was on 3/18, March 18th, and you got paid 73 cents per share you owned. So definitely good dividends on it, which is awesome. Ratings and analysis, as you can see here. And I want to break that down. We'll go over the dividends, but let's look at the top 3 and see what their dividends are. And I'll show you why I like just buying the individual stocks instead. So anyways, FactSet, efficiency, tradability, fit, they are all 4 stars out of 10. And long-term sentiment is strong. So if you're dollar cost averaging, that's good. Now, looking at this, hypothetical growth of $10,000 over 10 years, you can see you went from $10,000 over here, $10,000 all the way down to 5 in 2020 with COVID, and then you're up $5,000. But you still have your dividends reinvesting. So the life of the fund is still 8.36%. I just want to show you FENY, and I have a video on this, and I'll post at the end of this so you can see. But just compare FENY to XLE. The life of the fund is only 3.93%. So that shows you potentially who is the better investment. Maybe it is better to be more concentrated in these bigger oil companies, or maybe you just buy the top 3 and just dollar cost average into them and say kumbaya. So looking at the comparisons, you can see here we have the XLE and we have FENY. It's just good for you to see side to side. We both know they're passively managed. We both know that their net assets $39 billion for XLE, where FENY has an undefined $1.8 billion. So XLE, more money is pouring into this, and the expense ratio is basically negligible at 0.09, 0.08. Just looking at the key statistics, you could see here ETF, open investment company. It's not leveraged, it's not inverse, but XLE compared to its competitors is much stronger. I mean, overall 0.09% expense ratio. Dividend yield is much better, 3% compared to 1.62%. So overall, XLE is the better choice, and it looks like it's outperforming FENY. So definitely something to consider there. The thing I wanted to show you was, let's just look at the dividends real quick of these top 3 companies, ExxonMobil, Chevron, and ConocoPhillips. So this is a nice feature that Fidelity offers. When you're looking at the individual stocks that are listed within the ETF, you can just click on the symbol. So I clicked on ExxonMobil here. It'll load for us. And now we can go over like all the key statistics about ExxonMobil. So I just wanted you to see that when you're buying this ETF, ExxonMobil is at all-time highs. I mean, it is at the highest it's ever been. So you are buying stocks that, even though they make up 22% of this ETF, it is at all-time highs. So for me, that's definitely a red flag. Next is dividends and earnings. Without paying any fees, if you just bought ExxonMobil, you're making 3.12%. So that's nice to see. Next, I want to show you Chevron so you can see the dividends. So you're getting 3.12% just for ExxonMobil. For Chevron, we can see that we are making 4% dividend yield. And then if you take it one step further and just bought the top 3 of those companies, so you just bought ExxonMobil, you just bought Chevron, and then now you are going to buy, let's say, ConocoPhillips, because they make up the most of the ETF. Your dividends and earnings, 3%. So you'd be averaging 3%, 4%, and like 3.12% just on buying the top 3 companies. So it's definitely another strategy that some people will try to do, is they will try to buy these individual stocks within the ETF that make up the largest percentage. Because if you review XLE as its whole, just the top 3 stocks make up a huge percentage. I mean, 22, this is making up over 50% of the fund, and it's only 3 companies. So it's definitely something to consider if you want to get into energy, but you don't know who these other companies are. You can easily collect bigger dividends just going into this, but you have more concentration risk, and you need to make sure that your asset allocation of these individual stocks, I would recommend at least no more than like 5% of your portfolio. Like if you're buying ExxonMobil, less than 5%, Chevron, less than 5%, ConocoPhillips, less than 5%. Stick to your big index funds like S&P 500, etc. But I just want to throw that out there for something to consider. All right, guys, so there's definitely a lot between XLE and FENY, but I just wanted to give the different perspectives of it. This is my channel, Trading Simplified. If you like what you saw, I have so many playlists that you could look through. I have the Trading P&L 2024, where you get up to date every time I make a trade, win or lose. I up to date the year-to-date gains, investing ideas, my Fidelity index funds and ETFs, investing for beginners, long-term investments, and the Fidelity Active Trader program that I use every single day to make money on. And then I also have Vanguard investments as well. So you can check out all of my playlists here. Check them out. Tell me what you think. Leave some comments in the section below. Always appreciate reading the comments.